So here's a video on options for an Intro to Finance course. All right, you're going to know how to solve an exam-like question related to options in which you really only have to do one of perhaps three things: solve for the payoff, solve for the profit, and then draw a payoff diagram if needed. It's really typically as easy as that. However, this seems to be a daunting task for students, and I have a hypothesis. I believe is because this, chapter is typically at the end of the course or at the end of like the material for an exam. And students just don't want to study anymore. You're burnt at that point. You're like, I'm done. But thankfully for you, there's this video and there's a bunch of other videos on my YouTube channel and my website that are going to really guide you on this key step-by-steps to take to solve these questions in seconds, really to make this a fun process. And it's crazy easy, like you'll see. Okay, so let's go into it together, follow my steps, and I can promise you that this will never be a question that you'll be scared of moving forward. Okay, so I just gotta stretch a little bit. My shoulder hurts and my elbow hurts. But suppose that Jake and Sarah are interested in Tesla stock, which is currently trading at $37 per share. It's awesome. The couple is considering to buy the following two options on one share of Tesla stock. So we have two options and we have two specific individual options that we're going to look at. One will be the purchase of a call option, okay, with a strike price of $32, and the second one will be a put option with a strike price of $42. Just don't forget that that both of these are going to be purchases. Okay, so this is really important to remember that both of these will be purchases. So there's no sale or whatever. All right. And now the next step is so easy. I can't stress it enough. It's so easy. We're just going to draw a payoff table. Now, a payoff table is something that you should always do when you are computing for the payoff of a portfolio, especially when they're not giving you a specific price at expiration for the options. Most often than not, you will have to do this no matter what. Even PhD students, even professors really live and die by this technique. So please, follow it. It works, okay? So here's how we go about it. We're going to begin by drawing up, all right? I guess we'll go a little bit downwards. We'll go here. We're going to begin by drawing up our first columns. So the first column that we're going to draw up is going to be our positions. Our positions, what does that stand for? Well, it stands for literally the different, essentially, options that we're thinking about purchasing, okay? It really does stand for that. It's, for example, our call option with a strike price of $32, that's one position. Our put option with a strike price of $42, that's another position, okay? Really as easy as that. That's what that column tries to kind of define for you. Then we're going to have another set, like a category, okay, of columns that we need to look at, okay? And I'm actually going to highlight it like this, just for you really to get what I mean. The second set of columns will be stock prices, okay? Stock prices, well, more so a simulation of stock prices that we're going to go through to figure out, well, where is the optimal payoff for this portfolio, okay? So we need to run through a bunch of different stock prices. And typically students get confused at this stage, but you won't. You know why? Because there's actually a clear and easy technique to find the stock prices that you will need to input within your payoff table. The first step is literally to highlight all of the prices provided in the question. If we look at the question, you've been given three prices. You've been given $37, right? $32, and $42. So already there, you have three values that you could add directly to your payoff table. But wait a second, we actually need to find two other values. And I like to coin this as being the extreme technique, okay? The extreme technique, because the extreme technique is going to give us two specific values that we always need to place in within our payoff table, okay? And really, we could break it down as simply being like this. You're going to look for your lower extreme and you're going to solve for your higher extreme or your upper bound, okay? So your lower extreme will always be equal to 0. You're literally going to look at the lowest possible price for the stock. That's going to be like relevant for us, and in this case, it's $0. It's very much as easy as that. Now, for your upper bound, for your higher extreme, there's a few ways about doing this, and sometimes I only show one way, sometimes I show two. In this case, I'm gonna show y'all two. So two ways to find your upper extreme. It's very straightforward. You're either gonna simply take your smallest value plus your highest value. So you're gonna take your min plus your max. In this case, this would literally be, in this case, 32 plus 42, right? And that's gonna give you 74. That's one way to find your upper extreme. However, there's another way of going about this. You could take your min times 2. In this case, it would be 32 times 2. All right, and to make this clear, what I mean by min is literally the minimum value, so the smallest value within the prompt. What I mean by max is the maximum value, so the highest value within your prompt. Just to make it clear, the minimum value in this case, under my ghetto terminology, would be $32, and the max, right, the maximum value, the highest value in this case would be $42. All right. Now, the reason why I showcased both techniques is because sometimes your min won't be bigger than your max. Okay, like min times 2 won't be bigger than your max. And for that reason, it wouldn't make sense to add it to your payoff table because it won't give you a breadth of view here. It won't give you like a holistic view on all the different things that you may need to look at for your payoff table. So you can really pick and choose depending on the scenario. And typically, I like to go with the min plus max setup. Okay, so just you can use that to your advantage. Hopefully that was clear. So now that we have all of our values, we can actually plug this in within our payoff table. So we're going to plug in our columns. It's going to be the first, not the first step, but like the next step here. So we're going to have $0. So that's one column. We're going to have $32. It's another column. We're going to have $37. That's another column. We're going to have $42. That's another column. And then we're going to have the last column, which I'm going to use the min max version. So we're going to get, actually, I could get closer. I'm going to go with 64. You know what, YOLO. But once again, the reason why I went with 64 is because 64 is bigger than 42. But in some instances, what you're going to get from min times 2 won't be bigger than this amount. Okay. Try it in different questions and you'll see what I mean. Trust me. Okay. Now that we have all of our columns, we could actually start like defining our rows, our categories of rows that we may have into our payoff table. Now within your payoff table, there's two types of rows that you need to think about, two categories of rows. The first category, I literally talked about it, is our positions. So you just need to write down you need to like create rows for all of your different positions. Then the second category of rows that you may see within your payoff table is going to be your payoff, right? So the sum, okay? So we're literally just going to have our last row be payoff because we're going to add all of these together. You'll see what I mean in a second. So let's go about it. Actually, I'll make this a little bit bigger. Why not? You know, we have the space, YOLO type of thing. So here's one row. Here's another row. We're going to have our payoff at the bottom. Okay. Now, of course, the first row that we have here is going to be the purchase. So buy call at $32. And here's going to be buy put at $42. Okay. And we're going to try to compute the payoff for each and single one of these like stock prices that we're simulating. And for each and single one of these stock prices that we're simulating, we're going to do that for both positions. And we're going to add the payoff that we found for both positions for that given stock price. We're going to add them up together. We're going to do that for every single stock price. So for every single column. You'll see what I mean in a second. And at the same time, we'll define what the heck it means to have a call and what the heck does it mean to have a put, especially when we buy them. So we bought a call within the strike price of $32. And what is a call? A call is the right to purchase an underlying asset at a specific price for a specific amount of time. So in other words, in like layman's spiel or like normal people talk, having the right to purchase something at a given price is awesome because if the stock price is really, really, really high and you have a call option that allows you to buy it at a lower price, well, you're going to use that. That's awesome. But on the other hand, if you have a call option that's higher than the stock price, it wouldn't make sense to decide willingly to buy a stock at a higher price. You would just buy the market price, right? Because why would I pay more? In that case, you would not use your call option. So with that train of thought in mind, we're going to go ahead and we're going to look at the first position, which is buy a call at $32, and see what our payoff would be based on the different stock prices we have, based on the simulation essentially. So if our stock price is $0 and we have a call at $32, what are you going to do? Are you going to buy the stock on the market at $0, or are you going to buy the stock with your call option at $32? Now, I don't know about you. I like to save my money. I'm not going to willingly spend $32. So in this case, a smart person, a rational person, would not exercise their call option, and in this case, they will have no payoff, no returns, no savings. Okay, so we would have this equal to 0. Now let's say that the stock price of Tesla is $32, and you have a call option still at $32. In this case, you're indifferent. You could either buy in the stock market or you could buy your call option. It doesn't matter, but nonetheless, you would have no payoff regardless of what scenario you take. For that reason, your payoff would be $0. But now let's look at a different scenario. Let's say that the stock price for Tesla is $37. The stock price for Tesla is $37 and you have a call option at $32. Well, now you have an interesting decision to make because it's trading at $37, but you have the beautiful, amazing option to purchase it at $32. Imagine you could buy the stock for $5 less. You saved $5. That's your savings. In other words, that's your payoff. And of course, you will decide to save money rather than spend more money. In this case, your payoff would be $5. Now, if we continue with that train of thought, of course, if the stock price is $42, then your payoff would be $10. If the stock price is $64, your payoff will be $32. Look how awesome and easy this is. Just like that, we found all of our payoffs for our first position. Now let's look at our second position about our put option with a strike price of $42. Now, quick summary. What is a put option? A put option is the inverse, essentially. It's the right to sell an underlying asset at a fixed price for a specific amount of time. So you literally get to sell Tesla stock at a very specific price for an amount of time, which whatever, versus the stock price. So just to make this simple, when would a put option matter? Well, a put option would be dope if the stock price on the market is smaller than your put option, because then you get to charge others a higher price. That's dope, okay? That's amazing. So let's put that into practice. If you have a put option, okay, with a strike price of $42 and the stock price on the market is $0, what would you rather do? Would you rather sell to somebody Tesla stock at $0? Would you rather sell them the stock at $42 when you know it's trading for $0, such that you would be making $42 extra than what another person would make if they sold the stock? I think you're going to go with selling it at $42. So in this case, your payoff would be $42. All right. And if we continue on this train of thought, if the stock price is $32 and you have a put option at $42, this means that you could charge them $10 more. So your payoff would be 10, right? And if it's $37, your payoff would be $5. And if it's $42, your payoff would be $0. Now, why would your payoff be $0? Well, because you're not making a profit, right? You could sell it at $42 or you could sell it at $42. You're indifferent. Payoff is 0. But now let's say that the stock price for Tesla is trading at $64 and you have a put option at $42. Are you making any profit from the sale? Are you beating, are you selling it at a higher price? Hell no, you're not. So you're not making any payoff. In that case, your payoff, if the stock price was $64 for buying a put at $42, would be $0. Now, all that we have to do is find our payoff for every single one of these stock prices under our simulation. And what's awesome is that you just got to add this with this, and I can give you your total payoff. So in this case, we have $42 here, $10 here, $10 here, $10 here, and here we have 32 bucks. Okay. And we could clearly assume that this would low-key increase and this would low-key, I mean, we don't even need to go that far. Okay. So we have our payoff, and we notice that it seems that our payoff really does look pretty sexy towards right here. This is where we have the most optimal payoff. But we could actually even, like, if you were on an exam and they gave you different options, like a payoff that was bigger than this amount or this amount, then you could actually continue and look for higher stock prices and see if it ever kind of reaches like a specific value, if it ever like stays constant. But in this case, I know the answer, so no. But what we're going to do now is we're going to draw a payoff diagram. And you're probably like, oh no, not a payoff diagram. But a payoff diagram is actually mad easy to do. And we're going to draw a payoff diagram for every single one of these positions. Okay. So we're going to create one like little graph, and we're going to illustrate every single one of them. So we're going to have this one colored like this. We're going to have this one colored like this. And I guess we're going to have this one with this color. Okay, so here are our three colors. Let us build our payoff diagram. And this is an easy skill to have. So notice on our horizontal axis, we're going to have the price of the stock. Okay, so our x-axis, horizontal axis, the price of the stock. And on our y-axis, or vertical axis, we're going to have the payoff. Okay. Now, in this question, we seem to have a few payoffs. So we're going to have 0 here. So we're going to highlight 10 right here. We're going to highlight 32 right here. We're going to highlight 42 right here. Okay. And we have a few positions. We have 1, 2, 3, 4. So we're going to have 32 bucks here, 37 bucks here, 42 bucks here, 64 bucks here. Now, obviously, the scaling is absolute trash, but this is only made to give you some perspective really quickly. Like, I could make it closer. I guess I will, why not? Just to be, more on the ball. So let's kind of make it something that makes sense. So we would have 37 here, 42 here. Then we would have like 64 here, right? These would be dollar values. Okay. So here's our little payoff like table that we're going to build, or I mean diagram. So here's our payoff diagram. Okay. So we're going to go about this step by step. We're going to draw every single one of them, and it's going to give you a really good visualization like of what we're doing. And also, who knows, depending on what school you go to, depending at what time you're watching this, drawing a payoff diagram may be something that you need to do. Okay. So awesome. So let's go with our number one, the position at which we bought a call at 32 bucks. So if we're at $0 for our stock price, we have $0 as our payoff. If we're at $32, oh, and we also have $5. Whoops, let me draw that up too. My bad. We're also going to have $5 right here. Okay. And essentially, we could kind of like plot our lines one by one. So if we're at $0 for this, we get $0. If we're at 32 bucks, our payoff is $0. If we're at 37 bucks, our payoff is like $5. If we're at 42 bucks, our payoff is like 10 bucks. And if we're at 64 bucks, our payoff will be $32. So I'm going to try to draw a little time and look something that's not too bad. I mean, it's not the best thing ever, but you get what I'm trying to do. Okay, so just for sake of peace of mind, I'm going to take off those little dots, but that's what our payoff would look like for our initial position at which we bought a call option at $32. So notice how I guess we could kind of say, okay, 37 bucks right here. We have $5 realistically, but anyways, we'll keep it like that. I know it's not the prettiest thing ever. I'm sorry, but you get the idea. Obviously, on an exam, you're going to take out your ruler. You're going to be really cute. You're going to make sure it works. But for now, we'll work with this. So now we can look at our purchase of a put option. What's really interesting is that you notice that if the stock is trading at $0, you actually have a $42 payoff. But if the stock is trading at $10, you get a, if the stock is trading at $32, you get a payoff of $10. So you could write this like this. And if it's 37 bucks, you have a payoff that's at $5. And if it's at $42, your payoff is $0, and so on and so forth. Okay, so we could draw it up as being something like this. Although not the cutest thing ever, you get the idea. Now, of course, it would be a little bit sexier in real life if you were to use your, essentially your, it's really ugly, but still, you get the idea. On an exam, it would be a little bit straighter. That's like the theoretical perspective, but for my sake and purposes and for my mental health, we'll leave it like that. But you get the notion though still. And finally, for our total portfolio, we could actually kind of get fun with it. So we know that if we're looking at our total portfolio and its payoff, we know that if it's trading at $0, we know that our payoff will be 42 bucks. Okay. We know that if the stock is trading at 32 bucks, we know that our payoff will be 10 bucks. We know that if it's trading at 37 bucks, we know that our payoff will also be 10 bucks. This is awesome stuff. We know that if it's trading at 42 bucks, our payoff will also be $42. And we know that if it's trading at 64 bucks, our payoff will be $32, which is kind of crazy. Okay, so if we were to draw this, it would look something like that. You go all the way here, you go like this, then we would have our line. This. Now this would be our payoff diagram. Obviously on an exam, you don't have to do every single one of them. You do the one that they ask for you. But now you really get a perspective on what our payoffs would look like depending on our different positions. And that's really an amazing insight, and it's pretty awesome. So that's how you go about it. Now, of course, I would say that our payoff could get bigger, most probably as we increase our stuff. But on this exam, on this question, that's not what they're asking you. They're asking you to simply just draw one. And this is a very effective way of doing so. So hopefully this helped you out. Hopefully this gave you some context. Hopefully this really guided you on what should be done if you have to do a options question that kind of discusses payoff or profit or drawing a diagram of any sorts on an exam. So I'll see you in another video. Please make sure to look at ismahouse.com or Ismahouse YouTube channel, or literally just look up Ismahouse on Google, and you'd be surprised that there's actually a bunch of things that could help you out to do amazing in your course. So I'll see you on another video. Hopefully you're doing amazing. Don't stop. It only goes well from here. See you.